Look, loan officers, there's a lot of musical chairs going on in the mortgage business right now. Never really seen it quite like this. Lots of changes being made. When you're going to go work for a mortgage company, you want to know what that mortgage company is going to do for you. This is first and foremost the most important thing. Pricing comes and pricing goes. But service and amenities is something that sticks around. You want to have a mortgage company who maybe has a dedicated caller just for you and your team with scrubbed lists that comes with that person. Or maybe you want a company who's just going to buy houses outright to release contingencies. Maybe you want a company who's got a plan of attack for your realtor partner so you guys can be more successful, because that's the name of the game right now. And listen, if you want to have a conversation about some of the great things that mortgage companies can do for you and you're just not sure where to start, just reach out to us. Let's have a conversation about it. We don't have a dog in the fight. That's kind of unique. So anyways, click this banner right over there, and I look forward to talking with you guys and you gals about what you're thinking about the mortgage space. Or just reach out and say hi. Anyways, on with the show. Wells Fargo is getting out of correspondent lending. This is a really big story. It's really, really big. I don't think a lot of people understand just how huge Wells Fargo's correspondent division really is. It's absolutely massive. Now, this is pretty funny though. Just stick with me on this one. Wells Fargo says that they're getting out of correspondent lending because they are afraid that the bank would be responsible for reputational damage when it finances large amounts of loans originated from other companies like yours. That's kind of funny, isn't it? Wells Fargo being worried about reputational damage when it comes to mortgage lending is like Woody Allen being worried about the adoption process.
Third-party servicing business is expected to downsize as well, including the servicing of FHA loans. Servicing rights are treated as an asset by banks that generate revenue. According to the firm's SEC filings, Wells Fargo valued the servicing rights on its balance sheet at $10.39 billion as of the quarter that ended just June 30th of 2022.
Probably the best time in mortgage history to be in servicing right now. These loans aren't going anywhere. I don't think you'll really feel any pain at the pump with rates or servicing when it comes to origination. However, if we see other mega players getting out of the correspondent game as well, things could change really fast.
According to a monthly report from the National Association of Realtors, sales of previously owned homes fell nearly 6% in July compared with June, according to a monthly report from the National Association of Realtors. And sales fell about 20% from the same month of just a year ago. And most disturbingly, from NAR chief economist Larry Yun, builders are not building.
Yeah, builders ain't building, and it's a real hose job for the rest of us. This is exactly the precise time to build, not necessarily for profits, though you'll get them, but for the greater good of our country. Yeah, and profits. Why am I saying this?
Because the U.S. housing market is 5 million homes short of what would historically be deemed a healthy market.
Yep, 5 million homes short, and they're not building homes because that would affect equity in my house and your house. I mean, seriously, think about this. If I could buy your home and just your home, you have all the leverage. Or I could buy your home and a gaggle of other similarly built new homes. As the buyer, then I would have that leverage. And with that leverage, I'm going to bid down your asking price. This would be the consequence of building homes right now, which is why they're not doing it. And we can't have this type of stuff happening, can we?
The U.S. is short 5.24 million homes, an increase of 1.4 million from the 2019 gap of 3.84 million. That's according to new research from Realtor.com.
And from Housing Wire, Tuesday's housing starts report clearly showed that home builders are going to be done with single-family construction until mortgage rates fall. Housing completion data is still struggling to get some traction, but in the coming months, builders should be able to get more housing completions done, while housing permits and starts for single-family homes are in the decline right now. If it wasn't for solid rental demand boosting multifamily construction this year, 18% year to date, this data line would have looked a heck of a lot worse.
Here's the deal. With the softer market, sellers are beginning to back out of deals. Well, because they still think that we are in the same market we were 6 months ago, and we are decidedly not. It's your job as realtors to keep these clients on the rails.
When your clients are selling in a hot market, they like that. But they're also buying in a hot market as well, and that's as bad as the other is good. You need to tell your clients this, guys. When they sell in a soft market, not so good, right? They make it up on the purchase, don't they? The only difference is, with these two scenarios, taxes. And when it comes to sales and property tax, I'll take the lower one rather than the higher one. This is a great time to sell your house. Let them know that too. And finally, the FHFA and Jenny have lightened up on capital requirements for independent mortgage bankers. What this means is that in the same week that Wells leaves correspondent lending, which hurts, having more favorable capital requirements helps. This ensures that the lender you're working with today has a high probability of being the lender that you're going to be working with tomorrow, even if it's with a different hat on. You guys have a great day. We'll talk to you soon.